get some more on the declines we've been seeing in US equities. Seems to be a lot going on at the moment, a lot of news for investors to digest. Larry Shover, Chief Investment Officer at SFG Alternatives, joining us live now from the CME Group in Chicago. Larry, always great to get your views. Yeah, just firstly, what do you make of this pullback right now? What are you seeing?
The last couple of days in the market, I mean, to me, it's just been a healthy sell-off. I mean, let's keep this in mind. Last Tuesday in the United States, we had Hills and Rath speak on a webinar, and it created this weird, spiky, squeezy rally, kind of a last attempt to get in, and people grudgingly got in. And from that point, I mean, consider the narrative over the last 2 days has not shifted. It hasn't changed, and all of a sudden, you have the weak hands just selling out right now. In my mind, I still believe that 1950 to 1985 is a good comfort zone, and that seems to be the least path of resistance for the S&P 500, especially until we get that quarter three earnings season underway, where we can monitor if we're still getting momentum.
And obviously, as you mentioned, there's still a few weeks away, but I mean, what have you been seeing with some of the results, the August end results so far?
You know, they've been mixed, and I don't think there's enough to draw any conclusions. And I think that's one of the reasons we're starting to see implied volatility pick up just a little bit. It's very different than the second quarter. That was very drawn out in its process, and there seemed to be a lot of pre-announcements. Like right now, there doesn't seem to be a hold, or I should say not enough to make a conclusion, although stocks right now are concluding that we're going to see, $132 in the S&P 500. That puts us at a valuation of about 15 times earnings, which is starting to get a little bit expensive.
Just another issue as well, the US Treasury Secretary, this crackdown on corporate inversions, the notice released, the detail of the rules to be released next Monday, but it applies from now. So, how does this, put a dampener on M&A activity, for example?
Yeah, that's a great question. I think clearly that caused traders or people with weak hands that are just buying back and forth all day long, that caused them to sell. That just seemed to be a negative. However, if you look beneath the surface, and obviously I haven't read the tax inversion, but there's approximately 10,000 deals done in the United States this past year alone, and that includes mergers, acquisitions, corporate finance deals, et cetera. And I would suggest perhaps a dozen of those, just 12, were done with any kind of intentional tax savings purpose.
I guess just turning to China and, what we've been seeing there, and certainly that China growth worries has been blamed for a lot of the sort of weakness in markets. What do you make of that, given that we did see some data out yesterday that seemed to point to sort of a modest uptick in China manufacturing?
Yeah, and I've been a little bit down about it ever since that industrial production number came out not too long ago. But yeah, yesterday's number was definitely within reason, and it was a slight positive in my mind. I still think when you put all the numbers and sift them together with China, we're still talking about a GDP of 7.3 to 7.5. And I think the Finance Minister Lee is correct that he's not just going to engineer monetary stimulus until he knows something is working, until we see the economy heal a little bit. And they're doing a lot along those lines. I mean, a lot is left to be done, but they're going in the right direction.
Just going to ask you, too, about what we've been seeing in the greenback. I mean, obviously, the Aussie's been suffering here. The Aussie dollar has been suffering here as we've watched that greenback strengthen. I mean, what are you watching there and how are you trading that?
Yeah, I still continue to be long the dollar, and that's one of the few things that I've been right about. But it took a long time to be eventually right. I've been wrong about quite a bit, actually. And I'm fearful that it's a very crowded trade, and any kind of mixed news that comes out, it's going to reverse itself very, very quickly. But that said, I still think it's to play, and it's to play probably until the first quarter of next year.
Just in the moves in treasuries as well, we had that pretty weak European data. What did that do to global bond markets?
Yeah, well, yields have come off just a little bit. Let's keep in mind in the U.S. We had the U.S. Treasury at 2.6 on Friday afternoon, and now it's down 7 ticks from that point. It's just following in line with the European yields, and we saw Germany at 1% again and just a realization that there's no inflation whatsoever. In fact, the opposite. So it's going to be really hard for yields in the U.S. to get much higher than they are until we get some, subsidiary growth out of Europe.
And just very quickly, Larry, your overall view on the S&P 500, then on the US equity market, given we're seeing these declines, but what's your outlook? I mean, do buyers step in whenever we seem to see a bit of a pullback?
Yeah, I mean, I said that, I just got done saying that too long ago, that I think the S&P 500 is on the right side of fair value. It is a little bit expensive, but it's relative. So I still think it's a value relative to government bonds, corporate paper, even some real estate, or even some commodities. Hard to believe. But when you, in a relative basis, I still think the S&P 500 is a bargain. But I also think that 2025, 2050 is the top this year, unless earnings growth just goes way out the door from what anybody expects.